Welcome back to our channel. In today's video, we're diving into part 2 of our series on blockchain technology and its regulation in Kenya. If you missed part 1, make sure to check it out on our channel. Now let's get started. Yo, Kenya, the land of safaris, stunning landscapes, and blockchain? Yes, you heard that right. This East African nation, known for its rich culture and breathtaking wildlife, is now making waves in the tech world. Yeah, you heard that right. Kenya is quickly becoming a hotbed for blockchain innovation. Entrepreneurs and tech enthusiasts are diving headfirst into this digital revolution, eager to harness its potential. We're talking about a technology that has the potential to revolutionize everything from finance to agriculture. Imagine farmers using blockchain to ensure fair trade and transparency in their transactions, eliminating middlemen and boosting their profits. But with great potential comes great responsibility, am I right? Just like in a game of cricket, where every player has a role and rules to follow, the blockchain ecosystem needs guidelines to function smoothly. That's where regulation comes in. Just as an umpire ensures fair play on the field, regulatory bodies are essential to maintain order and trust in the blockchain space. Now, Kenya's not about to let just anyone run wild with this whole blockchain thing. The government and regulatory authorities are stepping in to create a balanced environment where innovation can thrive without compromising security. The Central Bank of Kenya, CBK, they're like the cool parents who let you have a house party, but only with some ground rules. They understand the excitement around blockchain but are keen on ensuring it's used responsibly. They've been keeping a close eye on cryptocurrency, which is like the wild child of the blockchain family. Cryptocurrencies have the potential to disrupt traditional financial systems, and the CBK is making sure this disruption is positive and controlled. They know this tech is changing the game, but they also want to make sure it's a fair game for everyone. Developers and innovators are working tirelessly to create solutions that are not only groundbreaking but also equitable. So, buckle up, because we're about to dive deep into how Kenya is navigating the exciting, sometimes confusing world of blockchain and cryptocurrency. From regulatory frameworks to innovative applications, we'll explore the multifaceted approach Kenya is taking to become a leader in this digital frontier. Whether it's in finance, agriculture, or beyond, Kenya's blockchain journey is just beginning, and it's one you won't want to miss. Stay tuned as we uncover the stories, challenges, and triumphs of Kenya's blockchain pioneers. In Kenya, cryptocurrency regulation is mainly governed by 3 key acts: the National Payment Systems Act, the Capital Markets Act, and the Kenya Information and Communication Act. Today we'll focus on the role of the Central Bank of Kenya, or CBK, and the National Payment Systems Act, known as the NPSA. Let's talk about the CBK, Kenya's financial watchdog. The Central Bank of Kenya, or CBK, plays a crucial role in the country's financial stability. It's not just about keeping an eye on the banks, it's about ensuring the entire financial system runs smoothly. They're all about keeping the Kenyan shilling strong and stable, which is kind of their whole deal. A stable currency is essential for economic growth, and the CBK works tirelessly to maintain this stability through various monetary policies and interventions. Now, cryptocurrency, with its decentralized nature and all that jazz, poses a bit of a challenge to traditional financial systems. Cryptocurrencies operate outside the conventional banking system, which can make it difficult for regulators to keep track of transactions and ensure compliance with existing laws. That's where the National Payments Systems Act, NPSA, comes in. This piece of legislation is designed to bring some order to the chaos, providing a framework for regulating payment systems, including those involving digital currencies. This act gives the CBK the power to regulate all sorts of payment systems in Kenya, including those funky new crypto exchanges popping up. By having this authority, the CBK can ensure that these new technologies are integrated into the financial system in a way that is safe and beneficial for everyone. Think of the NPSA as the rule book, and the CBK as the referee, making sure everyone plays fair. The CBK's role is to oversee the implementation of these rules, ensuring that all players in the financial system adhere to the standards set out in the NPSA. The CBK's main concern: protecting consumers and preventing money laundering. They work to ensure that financial transactions are transparent and that consumers are not exposed to undue risks. This involves monitoring financial institutions and taking action against those that fail to comply with regulations. They're not necessarily anti-crypto, but they're not going to let things get out of hand either. The CBK aims to strike a balance between fostering innovation and maintaining financial stability. They recognize the potential benefits of cryptocurrencies but are also aware of the risks they pose. By regulating these new technologies, the CBK hopes to create an environment where innovation can thrive without compromising the safety and soundness of the financial system. Now, the CBK hasn't been shy about voicing their concerns about cryptocurrency. In fact, they've been quite vocal about the potential pitfalls and risks associated with digital currencies. They've issued a bunch of warnings, kind of like those public service announcements you see on TV, but these are specifically for digital money. They want to make sure everyone is aware of the dangers lurking in the crypto world. They're basically saying, hey, crypto is volatile, like really volatile. The value of these digital assets can swing wildly in a matter of hours, if not minutes. You could lose all your money, so invest at your own risk. It's not just a game, it's your hard-earned money on the line. And it's not just empty warnings. The CBK has been backing up their statements with real-world examples and data. Remember back in 2018 when the price of Bitcoin crashed? It was a wake-up call for many investors who thought they were on a sure path to riches. Yeah, the CBK was quick to remind everyone that they told us so. They had been cautioning about the risks long before the crash happened. They even issued a circular to banks, telling them to steer clear of crypto businesses. This was a significant move, aimed at protecting the financial system from potential shocks. It's like your mom telling you not to hang out with those kids who are always getting in trouble. The CBK is trying to keep everyone safe from the potential dangers of the crypto world. They've also published detailed reports outlining the various risks associated with cryptocurrencies. These reports cover everything from market volatility to security issues and regulatory challenges. In addition to warnings, the CBK has launched educational campaigns to inform the public about the complexities of digital currencies. They want people to make informed decisions rather than jumping on the bandwagon without understanding the risks. The CBK is also collaborating with international bodies to ensure a coordinated approach to regulating cryptocurrencies. This global effort aims to create a safer environment for investors and to curb illegal activities like money laundering and fraud. Looking ahead, the CBK has plans to introduce more stringent regulations to further protect investors. They are constantly monitoring the market and are prepared to take action whenever necessary. Ultimately, the CBK's primary goal is to maintain financial stability and protect the interests of the public. Their cautious approach to cryptocurrencies is a reflection of this commitment. The NPSA gives the CBK the authority to regulate payment systems and payment service providers in Kenya. This includes overseeing mobile phone service providers to ensure that their platforms are safe for investors. In 2015, the CBK issued warnings about the risks of cryptocurrencies, highlighting their volatility and lack of specific regulation. Cryptocurrencies can be highly unpredictable, with prices swinging dramatically within short periods. This can lead to significant losses for investors who are not well prepared for such volatility. Despite these warnings, Kenyans are still pretty into Bitcoin. In fact, Kenya has one of the highest rates of Bitcoin ownership in Africa. In a country where access to traditional financial services can be limited, Bitcoin offers an alternative. Plus, with mobile money platforms like M-Pesa already so popular in Kenya, making the jump to digital currencies isn't that much of a stretch. Section 5. Regulating crypto through remittances. So, how exactly is the CBK trying to regulate cryptocurrency? Well, they're using their existing powers over money remittance services. See, a lot of crypto transactions involve sending money across borders, which puts them squarely in the CBK's territory. They basically said, if you want to play in the crypto remittance game, you gotta play by our rules. This means registering with the CBK, complying with anti-money laundering regulations, and all that good stuff. For instance, the price of Bitcoin has seen major fluctuations. In 2017, it surged to nearly $20,000 before plummeting to around $3,000 the following year. Such volatility makes it a risky investment for those unprepared for rapid changes in value. Section 6. Lapisha and Bitpesa, a regulatory showdown. Remember that whole play by our rules thing? Well, Lapisha Consortium Limited and Bitpesa found out the hard way what happens when you don't. These two companies were offering crypto-related services without the CBK's blessing. And let's just say the CBK wasn't thrilled. They slapped both companies with some hefty fines and basically told them to shut it down. It was a clear message to anyone thinking of dabbling in the crypto space: you mess with the bull, you get the horns. Despite these warnings, the CBK did not ban cryptocurrency trading. Kenyans are free to buy and sell cryptocurrencies, and they have embraced this freedom. Kenya holds over $1.5 billion worth of Bitcoin, which is about 2.3% of the country's GDP. This figure does not even include other popular cryptocurrencies like Ethereum and Dogecoin. Section 7. CMA enters the fray. Are crypto securities? Now, the CBK isn't the only one keeping an eye on cryptocurrency in Kenya. The Capital Markets Authority, CMA, they're like the stock market police, making sure everything's on the up and up. They stepped in and said, hold on, some of these cryptocurrencies might actually be securities. Now that's a big deal because if a cryptocurrency is classified as a security, it falls under the CMA's jurisdiction, which means a whole new set of rules and regulations. The CBK also regulates cryptocurrencies through money remittance regulations. Cryptocurrency companies must obtain licenses to offer transmission services within Kenya. Licensing is crucial for ensuring that these companies operate within legal frameworks and do not facilitate illicit activities. Section 8. The Howey Test and Wiseman Talent Ventures setting precedents. To figure out if a cryptocurrency is a security, the CMA uses something called the Howey Test. It's a legal test that's been around since the 1940s, but it's still relevant today. Basically, it boils down to whether someone is investing money in a common enterprise with the expectation of profits to be derived solely from the efforts of others. And guess what? In the case of Wiseman Talent Ventures Limited, the CMA ruled that the tokens they were issuing were indeed securities. This set a major precedent for how cryptocurrencies could be regulated in Kenya. A notable case is Lapisha Consortium Limited and BitPesa, where Safaricom suspended their M-Pesa services because BitPesa was operating a money remittance business without CBK's authorization. M-Pesa, a mobile banking service, is widely used in Kenya for various financial transactions. Section 9. Cryptos as securities implications for Kenya. So what does it mean if more cryptocurrencies are classified as securities in Kenya? Well, for starters, it means more oversight from the CMA. Companies issuing these crypto securities would need to get authorization from the CMA, provide detailed disclosures to investors, and comply with all sorts of other rules and regulations. It also raises questions about how existing securities laws, which were written long before blockchain even existed, will be applied to this new asset class. It's a whole new world, and regulators are still trying to figure out the lay of the land.